When we look at successful investors, it's easy to believe their strategies guarantee success. But what if we're only seeing the winners? Survivorship bias tricks us into focusing on those who made it, while ignoring the countless others who failed and disappeared. In investing, this can lead to dangerous overconfidence and poor decision-making. Are you learning from the right examples, or just the ones who survived? Let's dig into this hidden trap. Today we will talk about survivorship bias in investing. Are you learning from the wrong people? So before we start, make sure to hit the like button and subscribe to my channel. 1. Survivorship bias explained. Survivorship bias is a powerful psychological trap where people focus on success stories and ignore the countless failures that never make headlines. In investing, this bias leads us to study winners, top-performing stocks, legendary investors, or thriving funds, without considering those who didn't survive. For example, when people study successful hedge funds, they often overlook the hundreds of funds that closed due to poor performance. This creates a misleading view that success is more common than it truly is. The media amplifies this bias by spotlighting overnight millionaires, skyrocketing meme stocks, and sensational success stories, making it seem like these outcomes are typical. However, these survivors are statistical outliers. Ignoring the base rate, the number of failures, can severely distort how we perceive risk and opportunity in markets. Investors who fall prey to survivorship bias often overestimate their chances of picking winners or achieving similar success. 2. Illusion of easy success. One of the most dangerous outcomes of survivorship bias in investing is the illusion that success is easier to achieve than it actually is. When you only see the survivors, companies that went public and soared, traders who made millions, or funds that outperformed, you start to believe that success is inevitable if you simply follow similar strategies. This creates a false narrative that markets are predictable, or that with the right blueprint, you can replicate someone else's fortune. Investors influenced by this illusion may skip critical risk assessments, dismiss proper diversification, or heavily concentrate their portfolios on the latest winning sectors. This belief is further reinforced by social media, YouTube influencers, and investing podcasts that often showcase highlights of rapid gains, without mentioning the years of losses, failed ventures, or lucky timing that contributed to success. 3. The hidden graveyard. Every time you hear about a successful stock, fund, or investor, remember that there is a hidden graveyard filled with the stories of those who didn't make it. The financial markets are littered with failed companies, shuttered mutual funds, bankrupt traders, and businesses that never survived past their IPOs. However, these failures are rarely analyzed or publicized. Academic studies show that investment performance statistics often exclude funds or stocks that cease to exist, which can artificially inflate the average returns presented to the public. For example, when a fund company highlights its average fund performance, it may have already closed down its worst-performing funds, conveniently eliminating them from the dataset. This skews perceptions and leads new investors to believe that beating the market is more achievable than it truly is. 4. Misleading historical performance. Survivorship bias significantly distorts historical performance data, making past success seem more consistent and attainable than it truly was. Investment strategies that appear to outperform in backtests often rely on datasets that have excluded assets or funds that no longer exist. For example, if a research study reviews the top-performing tech stocks over 20 years, but only includes companies still trading today, it ignores those that went bankrupt along the way. This selective lens exaggerates the success rate of certain sectors or strategies. Similarly, when fund managers showcase long-term performance charts, they often present survivor-only data, neglecting the many funds that were liquidated due to underperformance. This gives investors an inflated sense of security about potential returns. Survivorship bias also impacts factor investing studies and index construction, where failed companies quietly disappear from benchmarks. 5. Dangerous role of influencers. Social media has amplified survivorship bias in investing to unprecedented levels. Influencers, YouTubers, and TikTok creators often showcase curated stories of success, quick profits, and market-beating strategies. Their content focuses heavily on the survivors, people who got rich flipping stocks, investing in crypto, or riding meme stock waves. Rarely do they highlight the vast majority who failed, lost money, or quit investing altogether. This creates a warped perception that successful investing is simple, fast, and widely achievable. The problem is further compounded when influencers claim to have discovered the next Amazon, or promote high-risk trades based on personal success. They'd often omit critical factors like sample size, survivor selection, and the random luck that played a role in their wins. 6. Survivorship in fund marketing. The asset management industry often leverages survivorship bias in its marketing strategies. When fund companies promote their top-performing funds, they frequently exclude the funds that were quietly closed due to poor results. This is known as survivorship bias in fund performance reporting. Over time, poorly performing funds are liquidated, merged, or rebranded, leaving only the surviving funds in the company's performance statistics. As a result, the average returns presented by fund families often appear much higher than they actually are across the full universe of funds. Investors who buy into these numbers without understanding the bias may believe they are choosing from a pool of consistently high performers, when in fact, many past offerings failed. This can lead to misplaced confidence in active management or specific fund strategies. 7. Learning from failures. One of the most effective ways to counter survivorship bias in investing is to intentionally study failures. Instead of focusing solely on how Warren Buffett succeeded, it is equally important to understand why countless other investors who mimicked him failed. Studying failed hedge funds, busted IPOs, collapsed companies, and broken strategies provides invaluable lessons in risk, timing, and human error. Learning from failures cultivates a more balanced and probabilistic mindset, helping investors appreciate that markets are not just a game of skill. They are often influenced by chance, timing, and survivability. For example, understanding why the dot-com bubble wiped out so many companies, or why so many day traders underperform gives you practical risk awareness tools. It can teach you about overleverage, poor diversification, flawed assumptions, and emotional decision-making under pressure. 8. Adopting a survival mindset. The most powerful antidote to survivorship bias in investing is adopting a survival-first mindset. Legendary investors like Howard Marks and Charlie Munger emphasize that lasting in the game is more important than chasing outsized returns. Focusing on avoiding catastrophic losses, maintaining proper diversification, managing position sizes, and understanding your personal risk tolerance should take precedence over trying to beat the market every year. When you prioritize survival, you're less likely to be seduced by aggressive strategies that promise quick riches but offer limited staying power. Investors who fall prey to survivorship bias often aim to replicate the success of those who took extraordinary risks and happened to win, ignoring the invisible graveyard of those who failed taking similar chances. A survival mindset acknowledges that randomness, volatility, and economic downturns are part of the investing journey. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.